Hi, my name is Joseph Perez, and I'm a financial advisory manager here at airCFO. Thank you for joining us for our second installment of airCFO's North Star Metrics series. Today, we will be discussing lifetime value and the related metrics of customer acquisition cost and payback period. We're joined today by Matt Hirsch of Fika Ventures and Erik Fogg of ProdPerfect, who will help to provide some insight from both the investor and the operator perspective. Matt, Erik, thank you both for joining. Would you guys mind kicking us off by providing a brief introduction, background, and overview of your current roles at Fika and ProdPerfect, respectively?
Sure. I'll go first since you mentioned my name first. Hi, everyone. I'm Matt Hirsch. Been with Fika for about 4 years now, was founding team of JetBlue prior to that, and also an enterprise sales and BD executive for 10 years. But yeah, an investor now. We invest in seed stage companies, typically first institutional check-in, $1 to $2 million, invest in enterprise SaaS and fintech and marketplace companies.
And I'm Erik Fogg. I'm the Chief Operating Officer and co-founder of ProdPerfect. We founded ProdPerfect in January 2018. My background is in operational excellence and industrial engineering, actually. And I got brought in by our product CFO, Dan, to help revolutionize the way that software and SaaS test their applications for quality assurance. And it's been a great ride so far.
Awesome. Thank you guys both so much. Great intros. And if it works for you guys, we'll kind of just jump into the questions then.
Great.
So the first one to kind of set the stage, and I know this is kind of a big question, so please feel free to take it in parts. How do you measure and track customer acquisition costs, payback period, and ultimately lifetime value? And how do you utilize these metrics in operational decision-making and performance tracking?
Yeah, I'll start since I'm the one doing it today. And I'll start generally, and then we can get into the details if we want about each of these metrics. But ultimately, for a startup at our stage, and where we are right now is we've raised 17 million, we have our Series A, and we're moving towards our Series B. Ultimately, for a startup at Series B, that's the time that you're really expected to scale hard, right? You're taking money and you're just turning it into more and more and more revenue. We'll talk a little bit about, in time, I think, when to start tracking these, but we're well in the middle of tracking them now. What we use these numbers primarily for is essentially turning dials. More important for us than the individual numbers of payback period, customer acquisition cost, and lifetime value are the underlying metrics that drive those. Of course, we want to maximize each of these. For us, the most important part is being able to make decisions about what changes to make, where to focus our engineering and problem-solving resources. And so we look at one level below of what's driving these, sales, onboarding costs, the human labor, the software, conversion rates, etc. We can get into all of that, but all of these, we are constantly prioritizing which ones of these should we be attacking in order to maximize ultimately our lifetime value and payback period as we prepare for our Series B.
Yeah, and I guess the only thing that I would add there, again, I think it doesn't make sense to go through the definitions explicitly of CAC and payback period and LTV, just given the plethora of information available on how to calculate them. But from an investor's perspective, it ends up being more around the trending of these metrics. As a seed stage investor, we're obviously not going to have these metrics. We may have some early signs of what these metrics are from companies that we choose to invest in, but we have to basically see that we believe that CAC can go down, LTV can go up, and that the payback period can be decreased. I think in the early days, the best way of understanding these are early wins on the sales front, early customer surveys, and scores like NPS, right, which tend to be more qualitative in nature, but it really gives an understanding of the business health and how customers feel about your business, without having the data that you would normally have in order to track these metrics much more effectively.
So can you tell us how do you factor in the interrelatedness of these metrics when considering whether to adjust operational inputs? So put another way, how do you take into consideration the connectivity of these separate metrics and the underlying metrics when you are deciding whether to pull a lever.
Great. Yeah, these metrics are all quite interrelated, right? So, your lifetime value is of course dependent on both your CAC, your margin, and your payback period is related to your CAC and your margin as well. So for us, because both lifetime value and payback period are primarily factors of CAC and margin, lifetime value also including churn or renewal rate, right? The way that we deal with these is we look at margin, we look at our CAC, and we look at our renewal rate, and we focus on those as the levers that we should consider pulling. We actually even look a level deeper than that. For example, Matt outlined that NPS is a key leading indicator for a seed company about what the lifetime value could be. For us, it's the leading indicator to our renewal rate or our churn. That's going to be a major factor in our LTV. And so we're focusing on how do we drive NPS up. And there's a whole team dedicated to that. It's our product team. That's what they do. Similarly, for our CAC and our margin, what we're looking at are, inputs to operational costs. For us, I think margin is a higher priority than CAC most of the time, in part for us because our LTV is pretty good because our churn rate is low and our renewal rate is so good. Customers for us get locked in. And so I think it's going to depend on your business a little bit. There are some businesses where they're kind of a bit of a spreadsheet SaaS in a very high competitive market. There's going to be a lot of churn. There's going to be a lot of poaching away of customers by other companies. What this means is that churn is harder to control. There's a higher level of effort, complexity, and cost in doing that. And so the thing to focus on is reducing your CAC as much as possible and improving your margins as much as possible. And so ultimately, I think for us, the factors that we most take into account about which of these interrelated metrics to go after is really about what's the total size of the opportunity for us and how much squeeze do we have to do for that juice. This is a very frankly intuitive kind of holistic call that you need to make as a COO. It's very hard to know what that squeeze will be using analysis. But if you really understand your business holistically, you'll have a very good sense of which of those three metrics is going to get you the most bang for your buck.
Yeah, and from my perspective, I don't want to repeat a lot of what Erik said, but we as investors are also always challenging companies to focus in on their CAC. But again, it's more about how CAC changes or evolves over time than the absolute numbers, right? Like, can a business who was sort of initially at like $1,000 CAC get down to $100 CAC, and in how many months, right? Which is sort of the equivalent to the payback period of an investment in helping to reduce that CAC. I think the critical piece is like understanding the why, right? You guys mentioned, the question is around the operational inputs and being able to tweak those. And, I think like a company that's aware of sort of what they did and how their actions affect things like CAC and other key metrics is critical, right? Because ultimately, like, then you'll be able to figure out if it makes sense to put your foot on the gas with regards to one of those sort of operational inputs or investments and show that, say, that 10x improvement on CAC is a sustainable one, right? What you don't want to see from a CAC perspective is sort of the roller coaster, right? That's kind of a no-no, because then it goes to show that like the company doesn't really have a good grip on like the factors that sort of affect CAC and what they need to do in order to maximize the LTV to CAC, which is ultimately the ratio that you hear everybody talking about and is sort of the critical one to get for an investor to get comfortable with. And so earlier stage companies, much better to focus on the discrete CAC, LTV, and the payback period on sort of a project or a campaign basis but know that like the things that you're doing to affect those discrete metrics will ultimately be rolled up into a full profitability analysis, which is ultimately the goal.
Great, thank you guys. That makes a lot of sense. Cool. So moving on, when should a startup begin monitoring these metrics? And which ones kind of should they start with? And how do you recommend going about finding a starting place to begin measuring these metrics and tracking them?
Yeah, and I'm happy to take this first, just given, again, we don't expect companies to come in at the seed stage with these metrics in place. It's very hard to do that. If you do that, and you have it in your slide deck or in your model, like we always poke holes in it because you typically don't have enough data in order to accurately track them. The more critical part is knowing that you need to track them. I like to use the database example, right? Like you need to set up a database to capture some data. Even if it's collecting dust, you're not doing anything with it, like it needs to be there. It needs to be the system of record. And so to the extent you can establish what the definition is of your metrics early on, either on your own or with support from a group like airCFO or others, to ensure that you're calculating those metrics based on sort of the generally approved like standards or definitions, will set you up for success. What's harder is when you do a bunch of things, run a bunch of campaigns, hire a bunch of people, you've got it as a line item in your model, but you don't have the basis for knowing like which sort of line items you should pull from in order to drive those ratios or those metrics. It's harder to go back versus just being able to set it up front. And most expense model templates like have the concept of CAC and LTV that are built in. I think the nuances are that each business is different, depending on if you're a B2B or a B2C or, like enterprise software or like, fintech or a marketplace. Like the definitions can be different based on industry or vertical. So it's critical to be as vigilant as possible and keep the data up to date so that you hold yourself accountable. And even if you don't have the numbers in the early days, you should still make sure that every month you're going back and you're including everything that should be included as inputs to help you drive what those numbers will hopefully be able to show you over time.
I have a somewhat controversial position on when a startup should really start seriously tracking these metrics, or at least seriously caring about the overall number. One of the things Fika is an investor in ProdPerfect. One of the things I really appreciated when we were fundraising for our seed is Fika we didn't sit down with Matt and Matt didn't say, what's your LTV CAC ratio? A lot of other investors did. We had been around for 9 months, right? At 9 months, asking what your LTV CAC ratio is silly and meaningless, right? And I think a lot of investors are pattern matchers looking for the familiar. The hard part about this is that startups are supposed to break the mold of the familiar. That's what makes for a great breakout startup, is that the old patterns don't apply. So I think even at a Series A stage, a startup should be experimenting aggressively, looking for, making cash investments to look for opportunities to make breakthrough changes to CAC, to LTV, to renewal rates. This costs money. And so if you just look at, say your last 3 to 6 months overall CAC, and if you're an investor or you're a CFO and you just draw a linear line out and say, oh, okay, I'm going to make an investment based on, the current growth rate, the current LTV CAC ratio, stuff like that, you're going to potentially miss out on a big opportunity that is unique to this startup. And so it really depends on what kind of investment are you making. For example, if you're investing in yet another CRM or yet another PEO, right, Competitive advantage is in the margins, right? And this can be economic margins, but also product margins, feature margins, where early on the economics do really matter because they just have to race out to market, right? It's a highly competitive field. It's one where there's very little technology moat. It's easy for competitors to come in and force down prices, which means that these underlying cost economics really matter early on. But then there's certain startups, I'd like to think we're one of them, that are making much more revolutionary changes in a wide open market with a very big tech moat, where the race is to build a product that is unassailable and can essentially create a monopoly. If you're doing that, there are heavy investments early on that can even make your margin bad early on. It can make your LTV CAC ratio look bad early on. A wise investor is going to get to the bottom of the story, the holistic story of a startup, to understand, what is this team doing? What is the market and the industry doing around them? That's going to change their broader trajectory. Is this a company that can really go become a $10 billion per year revenue company, at which point the margins today aren't as important. They should go get that revenue. It's going to be capital intensive, but they can go dominate a market and then pull the margins in later to improve overall LTV CAC. And so it really depends on what kind of investment are you making. Are you following a model that's been well trodden? Are you doing something brand new and revolutionary? And this is a little off the question of when we should track, because I agree with Matt that you should track right away. Even if you're highly experimental and not committing to trying to just eke out 10% more in CAC, you should know what you're doing so that you can actually see the results of these experiments that you're running and understand what impact they're likely to have. And then decide, are we going to stay in an experimental phase with this underlying metric, or are we going to lock it in and then move on to another one? Tracking this stuff very early, even in a rough way, is huge for letting founders and CFOs, COOs make rapid decisions, rapid experiments that they can finish and then move on to the next thing.
You both kind of started to speak to the next question, so let me know if we can skip over a lot of this, but maybe there's some more super practical advice you can provide here. But the next question is, are there any nuances that founders should be aware of when setting out to begin tracking these metrics? So, again, I know you guys both touched on the difficulties, whether it's the type of business versus, a different type of business or the stage of the company. But yeah, are there any really practical nuances or advice that you might be able to offer when first starting to track these?
With regards to CAC, I think the definition of sales and marketing expenses is the one to focus in on, and I think different people define sort of the S&M expenses, and should it be included or excluded? Again, there's industry best practices, but S&M typically includes advertising and marketing and the salaries and bonuses of sales and marketing, and sort of any other overhead costs, which is a bit of a catch-all. And depending on what you choose to include or not include, can be indicative of the outcome of the CAC metric. So it can either look super rosy or super terrible. And again, if you're presenting that in front of an investor, the good investors will want to dig deeper and figure out what assumptions that you made and kind of make their own assumptions of whether those sort of items should be included or not. So, I think that's my main feedback on CAC is make sure that you're going by sort of industry best practices of what should be included in the S&M expenses. For example, sales commissions are, I think, typically considered to be part of operating expenses. So it would be maybe normally in an income statement as an SG&A versus, not part of the cost of a product. But that may be different for different companies and different industries. So
I do think there are a few nuances to keep in mind beyond what we already talked about. I'll summarize one thing in a minute, but to piggyback off of Matt, looking in particular at CAC, understanding your marginal CAC versus your blended CAC is super critical, again, for making decisions, right? So you want to know your marginal CAC because you want to know if it's economical for you to take a channel where you're paying marginal dollars, such as advertising, and just turn the dial. right? Is it economical to do that? If so, great. Your blended CAC is also very important because you want to understand what's the impact of your organic, inbound and other, more brand-based, holistic marketing efforts. And if the advertising, or direct channel CAC is not as economical, then you do need to focus on being able to create, and everyone wants this, a more scalable, non-linear growth plan. But I think it goes the other way as well. For example, Slack is having a little trouble competing with Microsoft Teams right now, in part because they didn't invest in salespeople early enough. They said, hey, look, our CAC looks amazing, but they didn't have a marginal CAC because they didn't create a channel by which they could just arbitrarily add money and get more customers. And so when the sort of organic magical growth portion started to slow down for them, they didn't have a dial that they could play with. And I think that was Slack's doing fine, but I do think it was something that they're kind of kicking themselves for now. The other nuance that I want to discuss is, I'll just summarize something I said earlier. Ultimately, as a CFO or as a COO, it is critical that you understand in what ways your business is unique and does not follow previously trodden patterns. It's all too easy to just get caught in the same conversation that some radically different business had with an investor. And so if you're going for your Series A, an investor says, for example, why isn't your LTV CAC ratio over 3? There may be a very good reason that you've made specific decisions about who you're going after, what experiments you're running, what you're trying to learn at that stage, to not maximize that number as a vanity metric for your fundraise, but instead is in fact the right decision. And so I think there's a lot of thinking that needs to happen around what does health mean for our business, given what our trajectory narrative looks like. And you need a lot of courage to be able to hold your position when an investor is asking questions, and not think that the investor is sort of like an omniscient teacher that has all the answers, but is instead someone who understands broadly about the industry really well, but doesn't know your business as well as you do. And if you get good investors, which luckily we did, that almost creative tension between people who understand the patterns and the broad picture and you who understands your business really deeply, that creative tension can be really powerful, and you can all learn a lot from it and make better decisions from that conversation, as opposed to just kind of caving to, you read SaaStr and whatever the metrics say, you all just agree you need to hit those numbers now. That's essentially, it's lazy thinking, and I see too many founders do it.
Thank you. Yeah. Continuing on that train of thought, assuming that we can that these metrics are framed correctly and approached in the right way for the for the specific business, what can these metrics tell about a startup's actual performance and future potential as they go along the path?
What these metrics tell about the current performance and future potential of a given startup, in my mind, what's interesting is I think the momentary value of these numbers is not all that exciting. I think what's exciting are, one, the results of experiments, where you can demonstrate, hey, we tried X and it looks like the future looks like this. We can make this move over here. We can make a big investment to scale in this way. I think that's much more exciting. So experimental, contained versions of these metrics can tell us a lot about the future. And then also the rate of change, or the velocity of these metrics, I think tells us much more about the future than the current number. I'll use us as an example, ProdPerfect as an example. Like many machine learning driven startups, there's a lot of human in the loop early on, because what we're doing is, much like with machine vision, you need people to tag data constantly. What we're actually doing is building our product in situ with our customers. And so we have a lot of humans tagging a lot of data that are also involved in the operation of deploying our product. This looks like the margins are miserable, but what it's actually doing is these people are all feeding the machine learning machine with data sets that allow us to scale in a way that nobody else can touch, create a great moat, which means that, our long-term potential TAM is huge. And we haven't even brought up TAM, but that's got to be another metric that we talk about, because you can have lower margins if your TAM is, 600 billion a year, right? And nobody, and there's not a lot of competition in the space. All of a sudden, margins don't look nearly as important. But for us, seeing our margins improve over the last 6 months, even though they're not at that 80% that you would expect a normal SaaS to be, and not just improve, but improve with the right story, right? Hey, here we talked about early on with our investors, here's how we're going to improve margins by using those operational resources to build product that's more scalable, and it's happening in a way that affects all sorts of other things. For example, our ability to go get that TAM, but knowing that those metrics are changing, and knowing that the founders know why they're changing and that they're changing at will. Right, at the will of the investor, or at the will of the founder, rather than in a way that we don't understand. Those, for me, would be big indicators that we're on the right track.
Yeah, and from my perspective, I think you get a different answer based on the stage investor that you ask. So at a seed stage or even Series A, it tends to be all about the revenue. So these sort of metrics can help you to understand, what the revenue growth is. And then Series B and later, investors care about, the margin improvement that Erik mentioned. But, so ultimately, we want to make sure that the company is sufficiently capitalized and have a long enough runway such that they can drive enough revenue during that time to position themselves for the next round before they run out of money. And so I think if CAC or payback or LTV are sort of out of whack and maybe atypical, it would be a yellow flag for us, maybe a red flag for some investors, as Erik alluded to earlier. We would want to dig in and understand, why is that? Are there factors, decisions that the founding team is making that sort of are affecting it? Are they aware of it? Are they taking corrective actions to improve it? But ultimately, we want to make sure they don't run out of money, before they can get another tranche of capital. And so if CAC is completely out of the realm of reasonable, then, that's a red flag. And we would want to at least make sure that the company is aware and has steps to improve it over time.
Perfect. And so for the next question, I imagine this will also highly depend on the stage of the company. But in general, in your guys' experience, what are some characteristics shared by startups who have performed well when looking at these metrics, or have displayed a strong or productive pattern over time? When looking at all of these.
Yeah, I mean, without going into too much detail, because I know we don't have a whole lot of time, I think it's much more of the awareness piece, right? As hopefully you've seen from the comments that Erik's made today, they're super aware of these metrics. They're super aware of the things that they need to do to have an effect on those, and they know that they're trailing indicators, and they're going back and they're evaluating how the decisions they made impact these metrics over time. And so I think that awareness is the most important piece. And then, understanding through folks in your network, through your advisors and your investors, how you compare. Again, not every business is created the same, but certain industries have higher CACs and certain industries have higher LTVs. And if you're operating in one or more of those industries, it's to understand, are you bucking the trend? Are you doing things that are different, that are allowing you to gain an edge? And so if the answer is yes, then, you will likely be able to figure it out and put the foot on the gas, and maybe another capital and, invest, maybe another round of financing makes sense. So you can, put your foot on the gas and go harder and faster.
To Matt's point, I think the characteristics shared by high-performing startups that I've seen is that there is something about them. There's a leading indicator or a hint that one of these metrics either is or is about to be wildly better than the industry standard. Right? Because that's what startups are about. It's about exploiting some sort of gap in the market or new technology or something else that should be a game changer. And so should be looking for, generally your metrics need to be healthy, but there should be something that's game-changingly different. Otherwise, why are you there? So that's the thing I often look for is someone, when someone could go, look, my CAC is 0 for 98% of my, users on my app because of blank. That's something special, and something special is something that you want to double down on.
Great, and yeah, so it sounds like awareness is definitely kind of the fundamental factor, the starting point for a lot of, especially the seed stage businesses. Thank you. So for our last question, is there any other additional feedback that you guys can provide to founders who are looking to improve performance in these metrics? I know we kind of touched on starting to track and just becoming aware and gathering data, but yeah, for those that are kind of already on the path, is there any feedback to improvement?
I think the most important advice I can give to founders looking to improve these metrics is step away from the freaking spreadsheets. So what happens is, especially like CFO, COO types love bringing spreadsheets, love looking at the stuff. Spreadsheets are there to make you aware of the current state, and then they're there to tell you how your decisions have changed stuff. But you need to get out of that and get your hands dirty, right? If your sales CAC is too high, you need to be there in the sales process. If your margins are not there, you need to be in what's going on. These metrics are a result of humans in your company doing stuff, right? And not doing other things. And understanding both like the kind of the full, like for example, with sales CAC, understanding the full, end-to-end flow of customers going through that funnel, but then understanding at every point, what are people actually doing? It's the only way you're going to get insights to be able to make major changes. Trying to make changes from a spreadsheet is a waste of time.
Yeah, and I can't agree with that more. But the feedback I'd give to founders is, if you can't figure all that stuff out on your own, go out and get some help. Go to your investors. If you don't have investors, then go to your advisors, go to mentors, go to service professionals, right? Ask the accountants. There's lots of information online. Maybe it's not as applicable to your business, but these aren't new concepts and trends. These are sort of industry proven, hardened metrics and hardened ratios that have been shown to affect either positive or negative outcomes. So if you don't understand it, spend the time that you need to understand the drivers of the metrics. And if you don't know what to do to change it, then seek out help.
Great advice. Well, I think that's time for us. So Erik, Matt, thank you both very much for your time leading today's discussion. I'm certain everyone listening is going to appreciate the insights and thoughts you've shared, and is going to walk away with a better understanding for these important metrics, as will I. So thank you again for your time. We really appreciate it.
Thank you as well.
Thank you, Joseph. A lot of fun.